Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, this is the second video of Profit Prior to Incorporation chapter, and in the previous video we have seen the concept of this chapter as well as we have seen how to divide the expenses into pre and post columns, and we have discussed also a lot more things. Fine, so please watch the previous video and then come back to this video. I will put the link in the description below as well as I will put the link in the I button. Fine, so now you can click the I button and go to the previous video. Now in this video what we are going to do is, in this video we are going to solve the simple problem of profit prior to incorporation just to start off the chapter, and then we'll solve more problems in the upcoming videos. Fine, so now let's start. Now here is the question, let's analyze it. X Company Limited was incorporated on 1/7/2019. So here we can understand this company was incorporated on this date, on 1/7/2019. Incorporated means what? Incorporated means this company was registered under the Indian Companies Act 2013 on this date, on 1/7/2019. So I have told you in the previous video that incorporation date is the borderline. Incorporation date is the borderline. This is the date of getting certificate of incorporation. They got certificate of incorporation on 1/7/2019. 1/7 means what? 1st July, right? 1st July. Yes, this is the borderline. Now let's see what happened. To take over the business of Mr. A and B with effect from 1/4/2019. So here this X company, before it was not registered, before it was just called company for the namesake. Fine, so now they took over the business of Mr. A and B on this date, took over the business of Mr. A and B with effect from 1/4/2019. So on this date, on 1/4/2019, that is the 1st April, yes, 1st April, what they did on 1st April 2019, they took over the business of Mr. A and B, right? So now as you can see, this is the borderline. Now here they have taken over the business. So this is the date of taking over. It is called date of acquisition. Fine, and then what happened? Let's see. And then from the following information and figures relating to the year ending 31st/3/2020. So here the year has started on 1st April, right? Yes, and the year has ended on 31/3/2020. So the year has ended on 31st/3/2020, that is 31st March. Fine, 31st March, right? 31st/3. Yes, find out the profit prior to and after incorporation. Now here what we have to do, here we have to find how much profit was earned in the pre-period. Yes, that is period before getting the company incorporated. This is the date of getting certificate of incorporation, right? On this date the company became incorporated. The company became incorporated under the Indian Companies Act 2013. Yes, Indian Companies Act 2013. It got incorporated under Indian Companies Act 2013. Fine, so what we have to find? We have to find profit prior to and after incorporation. After means post incorporation. We have to find this. We have to find how much profit was earned in pre-period and how much profit was earned in post-period. Okay, and then what happened? And then they have said the sales for the year ending 31st/3/2020 were 5 lakh. So now they have directly given us the sales. The sales for the year ending 31st/3/2020 were 5 lakh. But these sales are of the whole year, 31st/3/2020. This is of the whole year, 5 lakh. Fine. But we want separate sales of pre-period and sales of post-period. So now let's see, divided into 1 lakh for the period up to 1/7/2019. So here they have directly given us the sales up to July 1st. Fine, that is the pre-period sales. How much are those? 1 lakh. So for the pre-period, how much sales we have got? Here they have given us 1 lakh sales. Yes, so 1 lakh sales go to the pre-period. Okay, pre-period, and then sales for the post-period also they have given us, see, and 4 lakh for the remaining period. So now if 1 lakh is till the pre-period, then what is remaining? If 1 lakh sales are for pre-period, then what is remaining? Remaining is post. So the remaining sales out of 5 lakh, if 1 lakh is pre, then remaining is 4 lakh, which is for post. Simple? Okay, you got this, right? Yes, it's very simple. And then they have said the gross profit for the year was 1,25,000. So they have given us the GP, okay, gross profit, and then they have given us lots of expenses. Yes, salaries, rent and taxes, office expenses, electricity, insurance, director's fees, auditor's fees, interest on loans, advertisement, and lots of expenses. Now I didn't have space here, so I wrote the remaining expenses on the right side. Okay, don't think these are incomes. No, these are expenses only. Fine. And then they have said net profit of the year 67,000. Okay, net profit is given, net profit of the whole year is given, net profit of the whole year is given 67,000. Now we have to find how much of it pertains to pre-period and how much of it pertains to post period. Fine, that is what we have to do. Now we will do that. See, then they have said ascertain the profit prior to and after incorporation. So they have said we have to find out the profit prior to and after incorporation. So now let's solve this problem and let's understand how to solve the problem of profit prior to incorporation. Okay, you got the question right? It's very simple. 1st April, the date of acquisition, 1st July, the date of incorporation, and then this is the year ending date, post period and pre period. And now one more thing we have to identify. See, 1st April to 1st July, how many months? That we need to understand, because we have to find out what is the time ratio and what is the sales ratio. So first let's find out the time ratio. I totally forgot about that. See, time ratio. Now how many months in the pre period? See, 1st April to 1st July, April, May, June, right? We will not take July. Why? Because it is 1st July. Yes, so we will not take July month into consideration, only June. Fine, 1st April, May, June. So 3 months goes to the post period. Okay, 3 months, 3M. Fine. And then in the post period, see, July, August, September, October, November, December, Jan, Feb, March. Yes, till 31st March, right? So 9 months. Okay, 9 months goes to post period. So now what is the time ratio? 3:9. So simple, right? The time ratio is 3:9. You can simplify this even further. 3 ones are 3, 3 threes are 9. So 1:3 is the time ratio. Simple, right? And then we have to find out the sales ratio. See now, here we have got the sales, 1 lakh for the pre-period and 4 lakh for the post-period. This is the sales of the whole year. This is not important for us now. This and this is only important, okay? The pre-sales and the post-sales. So 1:4. Yes, now let's find out. See, I will show you sales ratio. 1 lakh in the pre-period, yes, and 4 lakh in the post-period, yes. So now cancel out the equal zeros, 3, 3, 2, 2. So the remaining is 1:4. Yes, so this is the sales ratio. Simple, right? Time ratio is 1:3 and sales ratio is 1:4. Now with the help of these ratios, we will allocate these expenses into pre and post column. With the help of the ratios, we will allocate the expenses into pre and post columns. Okay, so now let's solve the problem and let's see how to do that practically. Fine, let's do this. Now after doing the rough work and then calculating the time ratio and the sales ratio and then going through the whole question thoroughly and analyzing it, now you have to prepare the statement of profit and loss for the year ending 31st/3/2020 as said in the question, right? So that we can find profit prior to incorporation and profit after incorporation, yes, post incorporation. Yes, so now the format of this statement is very simple. We have got particulars column, basis column, pre and post column. Now in the particulars column, you have to take the particulars of all the expenses and incomes, and then in the basis column, you have to write on what basis are you going to divide or allocate the certain expense into pre and post column. Okay, either it is time ratio, sales ratio, or it can be pre exclusive post. Yes, there are lots of ratios. Time ratio, sales ratio, and there are some exclusive expenses that will only go to pre and some exclusive expenses that will only go to post. Yes, we have seen all that in the previous video. So that is what we are going to do. So now let's start. Now the first thing that we are going to take is the gross profit. Why gross profit? Because gross profit is income. It is what? It is income. Yes. Why do we prepare the profit and loss statement? We prepare profit and loss statement so that we can find out the net profit. Yes, we can find out the net profit. So to find out the net profit, what we have to do? To find out the net profit, we have to deduct all the expenses from income, isn't it? We have to deduct all the expenses from income, then only we can find the net profit. Yes, so that is what we have to do. We have to take the income first. Okay, here gross profit is there. For example, if gross profit is not given, then you have to take the revenue from operation. What is revenue from operations? Sales. You have to take the sales. Okay, only if gross profit is not given. If gross profit is given, then take gross profit. and they can also give other incomes also, right? Rent from property, like that. Okay, rent received, okay, not paid, rent received is an income, so that will come in the income category. Okay, so now here we have got only one income, that is gross profit. So we are going to take first the gross profit, 1,25,000. Now you need to understand the gross profit. See, I have directly took the gross profit here. Yes, gross profit, and I have allocated it on the basis of sales ratio. The sales ratio is 1:4. Yes, now why did I use the sales ratio? Why? Because gross profit is directly related with sales. If sales increases, your gross profit also increases. Simple logic, yeah. If you sell more products, right, then your gross profit will increase. If your sales are bad, then your gross profit will be bad. Simple, right? Yes, that is why the gross profit will be directly related with sales. Fine. And now here we have calculated the sales ratio because we have got the sales here in the question. Yes, but what if the sales are not given? What if we cannot find the sales ratio? What if the sales ratio is not available? If the sales ratio is not available, then you have to look for the cost of goods sold ratio. Okay, you have to calculate the cost of goods sold ratio. If this is also not available, then the third preference will go to the time ratio. Okay, the first priority is the sales ratio, the second priority is the cost of goods sold, okay, COGS ratio, and then the time ratio. Okay, you have to go sequentially. Fine. Okay, fine. All right, now I have took the gross profit first. Yes, gross profit. Now I have used the sales ratio, that is 1:4. So now let's divide that. Okay, let's see how to divide. See, 1,25,000 is the gross profit. Yes, see, the sales ratio is 1:4. So 1,25,000 into 1 divided by 5. Yes, why 5? 1 plus 4 is 5, right? So 5, it's equal to 25,000. Simple. Yes, and then this goes to pre-column. This goes to pre-column, 25,000. Now how to calculate the post? See, you can just subtract this 25,000 with this 1,25,000, you will get 1 lakh. Or if you have to verify it, then see, 1,25,000, the total gross profit, into the post ratio. What is the post ratio? 4, right? So into 4 divided by 5. 1 plus 4, so 5. That is equal to 1 lakh. So 1 lakh will go to post column. Simple. Fine. So this is all income we have, right? We have only one income, so we took one income. This is the total revenue, total income, 25,000 and 1 lakh in the post column. You understood, right? Yes. And then you have to go on deducting all the expenses that you are given in the question. See the expenses? Salaries. Now tell me, what are salaries? Salaries is the fixed expense. Why is that? Because salaries are paid on regular basis, right? Every month. It is not connected with the sales. You have to pay the salaries of the employees, right? So it is fixed expense, so you have to do it in the time ratio. You have to do it in the time ratio. So I have done that. See, salaries 1:3. Yes, time ratio is 1:3. So salaries will go on the time ratio. Simple. How did I do that? See, salaries total is how much? 24,000. Yes, so 24,000 into 1 divided by 1 plus 3, right? That is 4 divided by 4, that is equal to 6,000. Simple. Then 6,000 will go to pre-column. Okay, salaries 6,000 will go to pre-column, and then remaining whatever is there of 24,000 will go to post column. See, 24,000 minus 6,000, that is equal to 18,000. So 18,000 will go to post column. This is better way to do it, okay, because it's faster than the calculating all the ratios. Okay, so this is how you have to do it. And then we have rent and taxes. Now what are rent and taxes? See, rent and taxes is a fixed expense. Why is that? Because you have to pay the rent every month regularly, right? You cannot avoid it. It is a fixed expense. You have to pay the rent, right? It is not connected with your sales, right? So here it is given 9,600. So you have to do the fixed expense. You have to allocate the fixed expense on the basis of time ratio. So this will be allocated upon the time ratio. Okay, 1:3. So how much it is? 9,600, right? So 9,600 into, see, 1:3. So into 1 divided by 4. 1 plus 3, right? So divided by 4, that gives you 2,400. So 2,400 goes to the pre-column. Fine. And then the remaining will go to the post column. See, 9,600 was the total rent minus 2,400, which has gone to pre-column. So the remaining is 7,200, which will go to the post column. Simple, right? Yes. And then we have the office expenses. See, office expenses. Now office expenses are also fixed expense, and you have to do it in the time ratio, because always there will be expenses in the office because employees are working there, right? It is not connected with sales. You have to incur some expenses in the office, so this is also fixed expense, so time ratio. Okay, 4,000. So here office expense, as you can see, 1:3, right? So 4,000 into 1 divided by 4, that gives you 1,000. So 1,000 goes to the pre column, and then the total is 4,000. So you can immediately understand, if 1,000 goes to pre, then the remaining of 4,000, that is 3,000, will go to post. Yes, 4,000 minus 1,000, remaining is 3,000, it will go to post column. Simple. And then we have electricity. Now electricity is also the same thing. Electricity is also fixed expense. Why? Because you have to pay the electricity bill every month, right, regularly, so it will be on the time ratio. Insurance also, you have to pay the premium regularly, right? So that is why this is also what? This is also time ratio. It's a fixed expenses. These are fixed expenses. Okay, so all these are in the time ratio. Here the electricity is given total, see, 2,000. So here 1:3, so 500 will go here, and then 1,500 will go to the post column. Fine. And then we have got insurance, the same thing. Okay, and then we have director's fees. Now this is very much important. See, you have to understand now director's fees. Now here in this period, in the post period, only there was company, right? Here only the company came into existence when it got incorporated under the Indian Companies Act 2013, right? Before this period, before the date of incorporation, there was no company here. Here there was no company, only here there was company. Now where are directors? Directors are only in the company. They are not there in the partnership firm, in the sole proprietorship business. No, they are only in the company, and the company came into existence legally only in this period, that is in the post period, after getting the certificate of incorporation. So the director's fees is an exclusive expense that will only go to the post. It will directly go to the post column. Simple. So director's fees will directly go to the post column, 3,500. The whole, see, director's fees 3,500. So that whole thing will go to the, it will go to the post column, 3,500. And then we have auditor's fees. This is clear, right? Director's fees, it's a company related expense, so that will directly go to the post column. And then we have auditor's fees. Now here the thing gets tricky. See, the auditor's fees. Now here you have to understand something. See, to allocate the audit fees, I've already explained this in the previous video. See, there are 3 types of audit: this internal audit, tax audit, external or company audit. Okay, but here we have got only auditor's fees, right? Here it is naked, right? Here it is blank. They have just said audit fees. If they had said internal audit, then we had done it in the time ratio. If they had said tax audit, then we had done it in the sales ratio. If they had said if it's a company audit, then we had done it in the post column. Okay, we have directly given it to the post column. But here it is naked, nothing is given. Auditor's fees 2,400, right? Now what we have to do, here we can assume that either it's internal audit and do it in the time ratio, or we can assume it is external or company audit. Fine. But for the BCom students, I will suggest assume it as an internal audit and do it in the time ratio. Okay, if they give you like this, then do it in the time ratio. You can also write the note below. It's better to write the note below, okay, that this audit fees are assumed to be of an internal audit, so we have allocated, so I have allocated it on the time ratio. It's fine. So now here we will assume that this auditor's fees is of an internal audit, so we have to divide this in the time ratio. Simple. So this is what we are going to do, but it's better to write the note. Okay, it's better. So auditor's fees, how much it is? It is of 2,400, so this will be allocated upon the time ratio. Auditor's fees time ratio, how much it is? 2,400. So 2,400 into time ratio is what? Time ratio is 1:3, right? So into 1 divided by 4, that is equal to 600. So 600 will go to where? 600 will go to pre, and then the remaining 1,800 will go to post column. Okay, you see, 2,400 minus 600, the remaining is 1,800, right? 1,800, that will go to the post column. Simple. And then we have got interest on loan, 1,200. Now interest on loan, this is also paid every month. It's a regular expense, it's a fixed expense. So fixed expense means time ratio. Simple. Time ratio is 1:3. Yes, so interest on loan will be done on the time ratio, and then we have got 300 and 900 here. How? See, The total is how much? The total is interest on loan 1200, right? So 1200 in the time ratio, yeah, in the time ratio 1:3, so into 1 divided by 4, that is equal to 300. So 300 goes to where? 300 goes to pre-column. Yes, 300 goes to pre-column, and then the remaining out of 1200 will go to post column, that is 900. Fine. And then we have got advertisement. Now here, see, now here things get interesting, right? Advertisement will go to sales ratio. Why? Because advertisement is directly connected with sales. It's a variable expense, right? If you want to sell more items, then you have to do more advertisement, you have to do more promotions, right? So promotion, advertisement, all this will be allocated on the basis of sales ratio. Now what is the sales ratio? Sales ratio is 1:4. Sales ratio is 1:4, right? So we have to do it in the 1:4 ratio. See, 1:4 ratio. What is the total advertisement? It is 1000. So 1000 into 1 divided by 5. Why 5? Because it's 1:4, right? 1:4. So 1 plus 4. So that is equal to 5, right? So 200. Okay, so we got 200 in the pre-column. Okay, 200 in the pre-column, and then the remaining out of 1000, that is 800, will go to the post column. Simple, right? See, 1000 minus 200, you get 800 as the post figure. Okay, the post figure is 800. Fine. So we have got the advertisement post, and then we have commission on sales. You see, commission on sales 2000, right? So now here you can just understand by just looking at it. Here sales is given, so you have to do it in the sales ratio. It's a sales commission, right? So it's directly related with sales. So commission on sales, sales ratio, okay, 1:4. Let's see, 2000, right? So 2000, fine, 2000 into 1 divided by 5. Why 5? 1 plus 4, right? So 5, that is equal to 400. So 400 will go to the pre-column, okay, 400 to the pre-column, and then let's see, 2000 minus 400, and the remaining will go to the post column. 1600 will go to the post column. Fine, simple, right? And then we have carriage outwards. Now what is carriage outwards? Carriage outward is the delivery expense, delivery of the products or the goods sold that are delivered to the home or the office or the place of the buyer. Fine, so this is delivery expense. Fine, so this is also directly connected with sales, 1250. This is directly connected with sales, so it's a variable expense, so you have to do it in the sales ratio. If sales are more, then carriage outward will be more, so sales ratio. Fine, directly connected with sales, 1250. So 1250, and what is the ratio? 1:4. So 1 divided by 5, that is equal to 250. So 250 will go to the pre-column. Yes, 250 will go to the pre-column. Okay, 250, and then the remaining, see, 1250, what is the remaining? Remaining is 1000, isn't it? 1250 minus 250, then the remaining is 1000. So 1000 will go to the post column. Simple. And then we have bank charges. See here, bank charges 400 rupees. Now bank charge is a fixed expense. Okay, it is not related with sales. It is a fixed expense. It is not related with sales. So that is why this will go in the time ratio. So how to do this? Simple, right? 400 into, what is the time ratio? Time ratio is 1:3. So 1 divided by 4, that is equal to 100. So 100 will go to the pre, 100 will go to pre, and then the remaining will go to the post column, 300. Simple, right? Out of 400, if 100 goes to pre, then the remaining is 300, which will go to post. And then we have bad debts. Now bad debts is related with sales. Bad debts is what? It is related with sales. Why? Because if you sell more goods on credit, then the bad debts, the chances of bad debts is more, so the bad debts are directly connected with the sales ratio. So it will go on the sales ratio. Okay, it is directly connected with sales, so sales ratio 750. So here 750, sales ratio is what? 1:4. So into 1 divided by 5, you get 150. So 150 will go to the pre-column, and then the remaining, let's see, 750 minus 150, then the remaining is 600. 600 will go to the post column. Simple, right? Bad debts, sales ratio, and then we have got preliminary expenses. Now preliminary expenses is an expense, it's an exclusive expense. It's an exclusive expense that will only go to the post column. Why? Because the preliminary expenses are incurred to create the company. They are incurred to create the company, so they are directly connected with company. so it's an exclusive expense that will directly go to the post column. Simple. Okay, so preliminary expense directly go to the post column. It is 1500, so it will directly go to the post column. Okay, on the post basis 1500. Simple. And then we have got depreciation. Now depreciation is not connected with sales, is it? No, it's not. You charge depreciation every year at the end, right? So it's a fixed expense that will be allocated on the basis of time ratio. Simple. 2800. So 2800 into what is the time ratio? 1:3, right? So into 1 divided by 4, that is equal to 700. So 700 will go to the pre column. Okay, 700 will go to the pre column, and then the remaining, let's see, 2800. Yes, 2800 minus 700, you get 2100. So 2100 goes to the post column. Simple. 2100. So now you have got all the expenses here. You have got all the expenses here one by one, and then you have got the total revenue over here. So now what you have to do, you just have to deduct the total revenue. You have to deduct the total revenue with the total expenses. Simple, right? If you add all this, you get 13,000. Okay, and if you add all this, you get 45,000. Simple. So now what you have to do, 25,000. Okay, in the pre column we are talking about 25,000, that is the total revenue, total income, minus total expenses 13,000, you get 12,000. Let's see, 25,000, fine, 25,000 minus 13,000, that is total expenses, 13,000, you get 12,000. This is the profit. This is the profit. If here the answer came in minus, then it means there is a loss, but here there is a profit. Okay, 12,000, fine. And then let's see in the post column. In the post column you can see the total income is 1 lakh. Yes, 1 lakh. So 1 lakh minus, this is total income, okay, in the post column, and then total expenses minus 45,000. Yes, 45,000, you get 55,000 as the profit. It's a positive, right? So 55,000. Okay, now you have to understand, now we have got two profits here. Yes, profit prior to incorporation and profit after incorporation. Yes, this is before incorporation, this is after incorporation. So now the profit prior to incorporation is called capital profit. It will be transferred to where? It will be transferred to the capital reserve. The profit prior to incorporation will be transferred to capital reserve. If there is a loss, it will be transferred to goodwill. Okay, that is why I have written over here capital profit. Capital profit will be transferred to capital reserve. Fine. And then if there is any loss or profit in the post column, that is after company is created, then that is normal profit as usual, right? So that will go to the net profit. Simple as that. Okay, 55,000, it will go to the profit and loss account. Fine, simple, right? Yes. Okay, so this will be treated as net profit and it will be shown on the P&L account. Okay, credit balance of P&L account. Simple, right? 55,000. Yes. Okay, and then this is the total column. Now here this is tally. Okay, this is tally. See, 25,000, 1 lakh. See, 25,000, 1 lakh, and here also 25,000, 1 lakh. This is the tally. Fine. So you understood, right? So this is how you have to prepare the statement of profit and loss. First, take the income, find out the total revenue, deduct all expenses. If the expenses are of fixed nature, do it in the time ratio, variable nature, then sales ratio, and there are some exclusive expenses which will only go to pre, such as interest on capital, and in the post, for example, preliminary expenses, directors fees, and then you have underwriters commission, right, interest on debentures. All this will go to the post column. Okay, so this is how you have to do the statement of profit and loss. But before doing everything, you have to understand what is given in the question. You have to analyze it and then find out the sales ratio and the time ratio and then do it accordingly. Fine. So this is how you have to solve the problem. And here it was given, right, net profit of the year 67,000. At the last, see, we have divided that profit into two. 12,000, that is profit prior to incorporation, and 55,000, that is profit after incorporation. So this is how you have to solve this problem. Okay, so now in the next video we'll solve more problems. Fine. Okay.